I just don't want to deal with it anymore. I made a decision at the beginning of the semester, even though we're not supposed to do it. I thought, stuff it. Yeah, that's not nice. I don't like, I've never been one, I've done a few semesters, so the last 2 years I've had the Saturday morning or Saturday afternoon exam. I don't want to ruin people's weekends, you know, especially around week 6, week 7, which is coming up Easter time and everything, you know, and like you think, no, because not only do I ruin your weekend, I ruin my weekend as well. So I'm not doing it out of self-interest. I've just always been of the opinion if you can't do it within a normal working week, then what's going on, you know? You need to be able to. So a Friday night, anything after 4:30 on a Friday? No, not on. No. Yeah. But we've had a lot of issues with timetabling in general, and that's why I just let go, because I tried multiple different things before I said no. And I thought, no. Yeah. Exactly. But I have to pick my battles. Okay, let's get started. So today we're looking at corporate disclosure. Now today's lecture is particularly important. Now, does everyone have the handout? So there is a handout. So there's a couple down the front and there might be a few scattered like up the top or the left. So we won't need it till near the end. You don't need it straight away. But go and grab the handout. Yeah, go and grab it. I think there's a couple up on the back as you're entering. Okay, so today's lecture is really about the bread and butter of what financial accountants do. So this is what we get paid quite a bit of money for in terms of the preparation of financial statements. And AASB 101 is something that you should become very familiar with because you will use it a lot. If you're going to be a financial accountant, so whether you're for a small business or a big business, this is where you make your money. Okay, so we're looking at chapter 5 from the textbook, so looking at disclosure and presentation of financial statements. And remember, it's really important because when we talk about, remember, like in the first lecture, I said one of the most important things accountants do is minimise risk, right? So in terms of the preparation and what you disclose and how you present it and how you put it together, that is what facilitates decision making, right? So from an annual report point of view, some of the data is old. But remember, if you're a company, you have to provide ongoing information to the stock exchange. You have to provide quarterly reports. You also provide interim reports. Even though interim reports that you prepare doesn't require you to comply with a standard, it's good to be consistent and just keep going, keep everything consistent as you're going through. Okay, so with this, in terms of the learning objectives, we're going to get a good feeling for what our general purpose financial reports are and what are the requirements in accordance with AASB 101. So your general purpose financial reports are a combination of reports. So your profit and loss, your balance sheet, your statement of changes in equity and your cash flow. Okay, so, and also the notes. Don't let me forget the notes, all right, because with the notes, you need to be able to explain. So what you see on the face of the statement compared to what's compiled in a whole report, all right, your face has summarised data and then you have a bunch of notes that require further description. So we'll go through some of those. Okay, so let's have a look. So we're going to do cash flow in week 10 and 11 with chapter 6. And remember, I've told you before, you will have a cash flow in the final exam. So don't miss that one. That's a lecture and a workshop you should attend, or make sure you watch the eye lectures for both. Okay, so when you have your complete set, you've got your balance sheet or your statement of financial position, Alternative titles are allowed, that you don't have to say that this is a balance sheet or this is a statement of financial position. You are allowed to apply different titles as long as it is a rule of thumb and common in the industry that you use, but the most common that you'll see is consistently being applied for a couple of 100 years now, well, about 100 years anyway, is balance sheet. Right, so it was first introduced in the 1800s. Actually, in America, it was the 1700s, late 1700s, where they started calling things a balance sheet, and they started using assets and liabilities and stuff like that. Okay, so you've got your profit and loss, so we'll talk about that. There are some variations in the profit and loss. Your statement of changes in equity, that's your shareholdings, your dividend payments, your movements in your retained earnings, so it's that equity section that you see on your balance sheet. Then your cash flow, then your notes. Now the other thing you have to remember, when you are preparing financial statements for a listed company, you must show comparatives. You must have the current year data and previous year data. If you've had a change in accounting policy, meaning maybe you've changed the way you measure assets, you must change the comparatives as well. So when they introduced some new requirements in 2005, where we had to use the International Accounting Standards, we had to do comparatives for 2004. So everybody actually had to start using the new standards a year early, right? So even though it wasn't applicable, so the new leasing standard, for example, it's applicable 1st of January 2019, but everybody would have had to have started it 1st of January 2018. They don't necessarily disclose, but they have to start putting in place in all the compliance, all right, so that they've got the comparative figures for the previous year as well. Now, let's have a look. Yeah, if you do any kind of reclassification of the line items as well, let's say, for example, you change, the materiality changes between an asset group and you want to change what's on the face, you know, you have to validate why you're doing that, because if something is on the face, it's important. All right, so you need to make sure that you have enough information within your notes to highlight why you're making those changes. So, as I've said, AASB does allow for alternative titles. Now, other reports that you'll find in the annual report, now online I have put 1 or 2 copies of annual reports up there. I think there was one of Qantas, one of Caltex. You can go and have a look at any one you like. So they're probably a little bit old. They were 2016. If you go and look at, sort of, say, Caltex or Wesfarmers, Wesfarmers is actually a really big one, so don't go and look at that unless you like looking at Wesfarmers. Caltex is quite comprehensive as well, but it's a little bit more concise, so it's probably a good little one to go and have a look at, and you can see how they put it all together. Now, when you look at an annual report and you see the chairman's review and a CEO's report, lots of summary data and financial ratios, etc., they are not covered by any accounting standard. All right, so they are, that's additional information that's provided within annual reports for shareholders because users are demanding that information. All sorts of stuff on corporate social responsibility as well. There is no standard that specifies anything to do with corporate social responsibility. Right, so no accounting standard anyway. There are some voluntary standards that some companies, and you know, they say that they comply with. They're not audited, right? They're not really audited, so you don't really know whether the information provided is true and fair because no one really signs off on it. And what that means for you as accountants as a new area, it's a new area to get into where you're looking at broader levels of compliance, and the last time I looked at it was about 1.5 years ago. I think there was only 14 people in Australia that were certified to do like environmental audits, and it wasn't like one person, it was a group of people, and because, you know, there's the financial side of it, there's the product responsibility side, there's the social side, you know, there's the human factor in all of that as well, so it takes quite a few people to do that kind of certification. A friend of mine in Indonesia, actually, she earns quite a bit of money. So they have quite a few clients, but there's a group of 4 of them, each with different skills. She has the financial skills, other people have different skills, and together They provide ISO, I think it's ISO 9001, I think it is, certification, which is an international certification for environmental management systems as a whole. So that's an area, and if you go and have a look at the big four, particularly here in Australia, they've started getting providing new audit consulting services as well. All right, and just remember, they're pretty expensive. So if you can start to provide those services to a smaller market, right, and get volume, but not charge as much as them, if you're able to get that kind of certification, it's definitely an area that people are, and businesses are actually adopting voluntarily, because they understand that depending on the nature of their business, if they're dealing in retail and manufacturing, for example, they have to look at product life cycle, so they have to take make a bigger effort making sure that whatever products that they're involved in producing and importing, etc., that they have a way in which they can recycle them or use them for alternative things like that. So all those kinds of things are changing, and they're changing now, and they'll definitely change in your working career. Okay, so getting to the general features of the financial statements as per AASB 101. If you open up AASB 101, any of you that have got your computers and you want to quickly log on and have a look, these items are specifically stipulated, right, in terms of what you have to consider in terms of your presentation. So what that means is, let's take a balance sheet. Every single line item in your balance sheet. So remember, you've got your assets, you've got your liabilities, and you've got your equity. So what sits under your assets? You might have cash, you might have inventory, you might have accounts receivable, right? You might have land and buildings and property and stuff like that. So every single line item, you need to be considering each and every one of those. So you consider it as a whole and for individual line items. So what you disclose must represent a fair presentation and compliance with the international standards. So, whatever the different standards for the different things, so there's an inventory standard, there's a property, plant and equipment standard, so you need to comply with all the standards. And you have to state that. That's actually a legal requirement. So when auditors go and certify, they actually certify that you have adequately complied with the standards and that your accounts represent a true and fair view. If they don't, then you get a qualification. So it can be a little one or a big one, and you don't really want to get an audit qualification, because what it does is it gives you a black mark, even if it's something, maybe not that important, or you don't think it's important. What it does is it highlights that your company is more risky. Right, so if you've got and it might mean that some shareholders will go, well, we don't want to be involved with this company anymore, we want to go and do something else. Right, the going concern assumption, where we are highlighting that business is going to continue into perpetuity. If the business is not a going concern, if it is facing liquidation or insolvency, then the rules are completely different. So we don't do it in this unit, but there are liquidation rules. I don't know what you have to comply with. That's a whole other legal area as well. Right, so not just an accounting area, but it's also, there's lots of legal requirements around insolvency and liquidation. Now, the accrual basis of accounting, hopefully you understand what that is, the fact that what you present, particularly in your profit and loss, your revenue and your expenses, the expenses that you show really should be a representation of those incurred in earning the revenue. So you're matching, right? So you're relating the revenue and expenses to the actual period. So that's what accrual accounting is. The reason we do that is that we have a date, right? So we have a tax date, for example, which is 30th of June. So that's probably about 80 to 85% of companies will have a financial year end of 30th of June here in Australia and around the rest of the world, because that generally coincides with the tax year. Countries that have different taxation, maybe they have a different year. The other one is the 31st of December, right? So as at that date, you need to group your revenue and expenses in accordance with accrual accounting. This is why we have accounts receivable, we have prepayments, okay, and we have accrued expenses, because we want to relate them to the period. Right, so make sure that we get them. And there's some examples that in your assignment as well. Okay, materiality and aggregation. Obviously materiality, hopefully that's self-explanatory for you, the fact that if something is excluded, will it change the decision? Right, so that's a simple way of looking at materiality. So it's not just about dollar amounts. So in auditing, they talk about lots of dollar amounts and materiality levels, and whether you take a 1%, 5%, 10%, 2%, 20%, whatever, depending on what the level of importance is. But from an accounting point of view, you have to think if you don't include it, what is the broader consequences of that? So sometimes even amounts that you might think are small, maybe excluding them is actually more important than you think, right? So maybe they don't need to be on the face, but they need to be in the notes, right? So things like contingent liabilities and things like that. So contingent liability is a liability where you could potentially have a liability. So for example, rehabilitation, if you're a mining company, you might have contingent liabilities into the future where somebody might sue you for something. Right, so those kinds of things. Offsetting. Now you are allowed to do some offsetting in accounting. For the most part, the answer is no, but there are some specific things that are, where they are the same, like gains and losses from the sales of assets. As long as those assets are similar and they're not completely different groups of assets, it's fine. And if you do condense it on the face, you must extrapolate it out in the notes to show the more detail if it relates to different groups, so that you're not hiding it. Foreign exchange gains and losses, things like that. That's something which is similar, very similar. You can offset, but again, if it could be material, or by aggregating it together and offsetting it, if it changes the decision making of the user, then you're not allowed to do it. All right, and that's something which is across the board. Frequency of reporting, according to the standards, it's a minimum of annual. Right, but remember, if you're a listed company, you have to provide interim statements as well, and you have to provide quarterly projections. All right. Comparatives, I've said that before, you must have the current year and the previous year. The other thing that you have to do with your projections as well, sometimes they want quite a number of periods in advance. All right, so if the stock exchange wants some additional information from you, you have to provide it. So there are minimum requirements, which is quarterly, so quarterly projections, so 3 months in advance, but occasionally they'll want a little bit more. Now, within the annual report, sometimes you'll see 5-year projections and stuff like that. That is the company trying to show their users, usually their primary resource provider being the shareholder, that they know what they're doing and that they've got a 5-year plan. Right? Some companies might only go 2 years in advance, but you'll find the bigger companies, they have to be a lot more strategic, try to be a bit more transparent, and they actually have 5-year projected info in their annual reports. They're not required to do that. They don't have to. All right. Consistency of presentation. You can't just go changing the way that you present things just for the hell of it. Right? You must be consistent. If you change something, the only reason you change it is because the nature of your business has changed. Right? If the nature of your business, and it happens. Right? You might be your main business area, or 80% of your functional business area might be in one area, but then you go, oh well, we're going to sell that off. You've got 20%, you want to build that up, and it's changed. Right, so if your business changes, then you can change your presentation along with that. Okay, so we've done the bit there on the fair presentation. You've got the notes, you know the going concern, we know about materiality and offsetting. Okay, so AASB 101, that does require the following information to be disclosed separately. The name of the entity, whether the report relates to a single entity or a group of entities. So where a company is the main company and they have subsidiaries and they have group accounts, they need to highlight that these are group accounts. Then you have the main parent entity, right, and then the group. Right, so you need to show, if you go on and have a look at Caltex or BHP or Wesfarmers or any one of those, you'll see that they provide group accounts. So they can choose to show the parent on its own as well on the face. So sometimes you'll see 4 different columns just for the parent company and then the group results. So in the back of those annual reports, they must list all the subsidiaries as well and the percentage of shares that they hold, right? They must show the top 20 shareholdings, all right? So that for most companies, big companies, the top 20 shareholdings probably represents in excess of 90%. So you've got big institutional investors that hold very large parcels of shares, all right, in the company. And that is a stock exchange listing requirement in terms of presentation, and it's in the corporations law. You must show the reporting period, so it's for a balance sheet, it's as at the 30th of June, the currency, if it's Australian dollars or US dollars or euro or whatever. The reason with that, if items have been converted, you must show your policy on how you convert your foreign currency as well, right? There's a whole standard that deals with foreign currency and how you can account for it. We don't do that in this unit, I do it in another unit, and there are multiple ways that you can account for your foreign currency, all right? And the rates that you apply, whether you use an average, whether you use the opening rate, the closing rate, all that kind of stuff. Any rounding used, so you'll find that most annual reports will be rounded down to thousands or millions, all right? So you'll have like 3 little zeros you'll see on the top of the column, or you'll have a dollar sign and an M, so you'll know it's millions, right? The trick is to go and have a little bit of a look at these things so that you start to become familiar with it. Okay, so with your balance sheet, there are, AASB 101 doesn't actually tell you what you have to do. It does give you some minimum requirements. You must differentiate between current and non-current assets and liabilities. So that liquidity clause is there, you must do that. Now your current assets and current liabilities are items where you're going to get the benefit or you're going to have to pay within 12 months. All right, so you should be able to reasonably estimate that. Right, the reason that you need to differentiate between the current and the non-current is, again, it's about risk and short-term risk and looking at your ability to pay your short-term debt, if you have any. So that is that's one of the minimum requirements, but you'll find that the traditional balance sheet, it starts off with your assets divided into current and non-current, then you have your liabilities divided into current and non-current, and then you have your equity, right? But some countries around the world, they will actually have liabilities first, all right? And the reason that they do that, and it's not unusual because that's how they originally started to do it. So if you go back to the very first accounting, back in the late 1700s, they always put the liabilities at the top, right? Because that's your risk, isn't it? Right, that's your main risk area. So you'll find that some countries do that, and that you can do that. You'll also find that some countries will group all their current assets and liabilities together under one heading. So you have it all under one, and then you have your non-current under a separate section. So the standard doesn't preclude you from doing that. The way that you present it should represent the way that you run your business, right? So whatever you do, whatever is generally expected in the industry in which you're operating, that's what you should, look at best practice. Right, and you'll find that the majority, though, doesn't matter where you are in the world, the majority will always have assets first, liability second, equity third, all right, in your balance sheet. Okay, so moving on from that, depending on what is shown on the face of the statement, there are 3 items here that we've highlighted: the nature and the liquidity of the assets, the function of the assets, and the amounts. Where is that? It's not there. Sorry, I was just looking for a different component. Okay, so depending on whether you can condense them, you've got to go back to your original items earlier, where it looks at materiality and whether its exclusion changes your decision making. All right. So if it's not on the face, you can still have it in the notes and it's okay. All right. So, but if it's really important, it should be on the face. Right? What will happen is that shareholders and analysts, if you've got something and you've tried to hide it away in the notes by amalgamating stuff, but they know it's going on because there's lots of information about it in the public domain, they'll think that, you know, maybe you're trying to hide something. Okay, let's have a look. Further sub-classification. So within your inventory, so normally what you'd have with your inventory is you have inventory on the face, and then in the notes you would subdivide it into raw materials, work in progress, and finished goods. All right, that's a requirement of the standard, that you should show it that way. Not only is it in AASB 101, but it's also in the inventory standard as well. They highlight the disclosure requirements there. Property, plant and equipment, you must, on the face, you'll usually just have property, plant and equipment. Then you go to the notes and you'll have it all itemised out. All right, so you'll have your land, so your property, buildings, your different main classes of assets. All right, so you would group your classes of assets according to like how they fit together. So when you go to the asset standard, which we don't do in this unit, the AASB 16, they actually look at, I don't want to confuse you, cash generating units, all right, which allows you to group assets which are not particularly alike, but because they are used together to make money, you can aggregate them together. Right, so they have what we call cash generating units. So again, it depends on the nature of your business and the decision making being undertaken as to whether it's appropriate to do it by the type of asset that it is or as a cash generating unit. And remember, where valuation is concerned, some things are valued differently on their own compared to when they're valued in a group. All right, so that can create issues from a valuation point of view. All right, so that's something to learn about another time. Okay, here are some of the minimum requirements in your balance sheet. You must show, if you've got property, plant and equipment, you must show your property, plant and equipment. You must differentiate between investment properties as well, compared to properties that you are using to run your business. If you're an investment property type business, it's different, obviously, all right? You must show intangible assets separately. Unless they are immaterial, you can group them with other assets and then show them separate in a note. Financial assets, all right, so you must show your financial assets. Biological assets, so that's things to do with agriculture. So if you've got biological assets, so whether you grow trees or you grow cattle or you've got orange grove, things like that. Inventory, you must show your inventory as a line item and then you must separate it out in the notes, right? You actually can show it on the face if you want to. If you want to have your raw materials, work in progress and finished goods on the face of your statement, you can actually do that. The standard doesn't preclude you doing that. But what you want to do is you want to have your face of your statement nice and neat, right? Then you have a note, you go to that note and you see what all the detail is, because it just looks better. From a professional presentation point of view, it looks better, and when you look to what industry is doing, that's what they tend to do, right? I'm telling you this because I'd like you to go to the extra step when you're doing your assignment, because it's about presentation, all right? Your trade and other receivables, and within that, obviously, you've got your estimations for doubtful debts, all right? So you need to separate them out, put them in a note. Your cash and cash equivalents, which are different to your other financial assets. All right, your other financial assets are assets that are easily convertible to cash, where your cash and cash equivalents is usually you've got physical cash that you can get almost immediately, all right, from your bank account. Assets classified as held for sale, right? That's one important thing that you must separately disclose. If you are making decisions to sell assets that are material, you must show them separately. So if you're selling a building or a big group of property, plant and equipment, if you're holding them off for sale, or maybe you've got inventory that you're selling off to somebody else who's going to try and sell it or something like that. So all those assets that you would normally be using within your business, you need to maybe classify them separately, right? If you are actually maybe getting rid of a whole portion of your business, right, and you're selling a whole lot of plant and equipment, etc. So, same goes on the liability side. These are the minimum items. Okay, you must show your trade and other payables. If you've got any provisions, right, so some common provisions would be for leave entitlements. So in Australia, long service leave, annual leave, things like that. Maybe superannuation if you have a defined benefit scheme. So there's different types of superannuation schemes, but where the employer has to take on the liability and it's not being run separately by different funds. So when you've got that, the employer, where the employer has to take some of the risk of shortfalls in funds, you have provisions. Liabilities as well, your tax liabilities. So you've got current and deferred tax liabilities, right, that you need to show, and or assets if it relates. So in in ACT 5013, you should have done taxes, all right, so looking at your current tax obligations and deferred tax obligations. So I'll put I'm not sure if the reminder one's already up there, but you need to know a little bit about that for cash flow. More about just the terminology rather than doing it, right? So just understanding the terminology and understanding the accounts and the T accounts and how they interact. And also for your consolidations, because your consolidations can cause deferred tax assets and deferred tax liabilities. So it's more about the terminology, so a little bit later on. But there'll be reminders when we get closer to that, because it's a few weeks away now. Okay, so those are the minimum items, and if you pulled out the standard, it's very, very clear. So when you get out into industry, if you're not sure what you're doing, just pull out the standard. It's actually there in black and white. All right, what is the minimum requirements? And usually if you're going into an organisation, they've already got things set up, so you can have a look at their base and then make sure that they're complying if they need to. Remember, a lot of small businesses don't need to comply. All right, they need to be able to prepare financial statements so that enables them to run their business, prepare BAS statements, and keep good, accurate records in case the taxman wants them to. Right? So you've got a lot of variation. So unless they actually have to report to an authority, because sometimes they do, right? Occasionally they get asked to report to the ACCC and stuff like that. Then in those instances you need to make sure that you've got good records. Okay, so with a statement of financial position, so your balance sheet, there is judgment on whether to present additional items separately. So when you're making those judgments as to whether you need to separate them out or group them together, you look at the nature and the liquidity of the assets, the function, the amounts, the timing, so that notion of materiality comes into it. So just highlighting that again. Just remember that when you're looking at your balance sheet, your formula comes back into play. So your assets minus your liabilities equals your equity, or your assets equals your equity minus your liabilities. So you'll see that presentation as well. So you'll be either reconciling to net assets, which is your total assets minus your total liabilities to give you net assets. That must equal your equity. Or you have assets and it reconciles to your total equity and your liabilities. Right, so both those presentations are acceptable. Right, the latter, the total assets minus liabilities equals your equity, is the most common. All right, so remember where your equity is concerned, it does include, so a lot of students forget this, if you're not doing it all the time, they forget that your equity includes your retained earnings, which is your accumulation of your profits. So you should always prepare your profit and loss first, and your profit or loss, that flows through to your balance sheet, and that is your balancing item. All right, so when you do your profit and loss, you only include your revenue and expense items, end up with a profit. That profit needs to go through to your balance sheet in your equity section, all right, in your profit section. So you'll see the terminology retained earnings a lot. That is the accumulation of your profits over a number of periods. All right, so we will remind you of that when we do an example near the end. Okay, so let's have a look. So there's a little example of a standard top part of your assets with your consolidated balance sheet. So when you see the word consolidated balance sheet, that generally means it's a group account, right? Because they have consolidated the parent with the subsidiaries, right? So you'll see at the top, the 2 years is 2015 and 2016, so we've got comparatives. You'll see that we've got a dollar sign and an M, so it's in millions of dollars. Right, so that's important. You'll notice we start off with our current assets, move through to our non-current, and then we've got a total. For most of them, we have a separate note. So with your cash and cash equivalents, we'd go to note 8 and have a look at what that is. All right, see what's in there, what's that made up of. With your non-current assets, if you've got property, plant and equipment, in note 11. All right, so for some of you I might be stating the obvious, but if you're not used to looking at them on a regular basis, that should just give you some guidance. And you need to think about that in terms of your presentation for your assignment, having separate notes if required. Okay, so see there for note 8, we've got cash and cash equivalents. It's broken down into your cash balances. They got 311 million in 2016. They got cash at call, short-term money market securities. Right, so your receivables, they've got current and non-current receivables. Notice how their receivables, they have it divided into not past due, so it's just due now. So there's $571 million worth of monies that people owe them. It's a lot. You know, you have to remember, when you're in business, you're not a bank, right? You're in the business of, you know, providing services or whatever, but you're not a bank and you can't have too many accounts receivable. So depending on the nature of your business and who your customers are, right, you need to make sure that people continue to pay their bills up front, or you get deposits up front, right, so that you're not having to chase after people. So they also divide it into, if they're overdue by 1 to 30 days, 31 to 120, and over 121 days. Obviously, if you're a small business, so in your assignment, you have to run a little receivables report to see what's current, and there's different ways you can set it up: 7 days, 14 days, 30 days, plus 30 days. So depending on how you run your business, you want to make sure that people are paying you and that you have what we, in the old school, we used to call dunning letters, but letters of reminder letters for people that they've got outstanding bills. So generally the first thing you would do, if someone is they've got an account and they're supposed to pay within 14 days, at that 14-day mark, if they haven't paid you, you would run a statement for them and you'd send out the statement saying this is what you owe. If you let it go for another 7 to 14 days, depending on how you run your business, the next one, not quite, it's not just a reminder, it's, you know, you haven't paid. Once it gets sort of a little bit, you know, you might let them go another 14 days, then you would send out the letter which says it's going off to the debt collector. all right? But then it depends on who they are and, you know, what agreements you've come up with. But most businesses, even small businesses, they have dedicated people that are doing that, because for some businesses it's actually very difficult to not allow credit, right? For some it's difficult not to, depending on who you're dealing with and what businesses that you're dealing with. So if you can not do it, then don't do it. Right, but if you have to put very good controls in place to make sure that you get your money, because you're not a bank, you're not in the business of providing goods and services for free, right? But you can be reasonable, right? So, but only to a point. Property, plant and equipment, notice how we've divided it into, like the previous year and the current year, how we've divided it. They've divided it into their core assets. They've got land and buildings. So obviously this is Qantas, their aircrafts and their engines are quite high. There's like, so what, $20 billion worth of aircraft? So that's in 2016, and maybe they might have a few issues next year, because what was that new Boeing plane that they're having all the trouble with? They've grounded them all, and because of the unfortunate accident with Ethiopian Air a week or two ago. So there's some kind of a fault, right, with that plane. So they were all grounded. So some people might have some big losses, some big write-offs if they're not able to fix that. But I'm not getting in it. So neither will anybody else, will they? They'll just go, nope, if you haven't worked out what the issues are, because it's obviously a technical fault. Yep, but don't want to think about that. And if anyone's getting on a plane, don't think about it. Okay, your liabilities, again, same scenario. You're divided into your liabilities, current and non-current, and then you've got your equity down the bottom. So notice how we have our net assets of 3.2 billion, and then that balances to our equity of 3.2 billion. All right, that's why it's called a balance sheet, because it balances. All right, the tricks, if it doesn't balance, you've got to look for the exact dollar amount. That's the first step. If you're out by, 10,000, for example, look for that 10,000. If you can't find it, look for half of it, and then look for double it. Right, because sometimes you might have done something wrong with your debits and credits. You might have put something to the wrong side somewhere. Okay, there's your provisions. Just to give you an example of some of the provisions, you've got annual leave, long service leave, any defined benefit liability. That's what I was talking about with the superannuation. There's not that many defined benefit superannuation funds anymore. All right. Most employers, we have the other funds, right, where the risk is all within the fund itself, right? Whereas with a defined benefit, you're guaranteed a certain amount, and if that's not available in the fund, if it hasn't made enough money to provide that, then the employer has to pay the difference. Right, so I'm lucky enough that I've got a defined benefit fund actually. So, but there was a few problems a few years ago, and you need to look out for these with your super, and you need to think about it sooner rather than later. Particularly those that are in Australia and you're going to be staying here for a long time, you need to make sure that you manage your super from a young age, because if you start doing it right, a lot of people think, I don't have to worry about it for 40 years. If you make good decisions now, 40 years down the track, you could be an awful lot better off. Right? So it's good when you're younger, be a little bit more risky, right, and actually look at what your fund is investing in, and maybe try to get some things with some higher return. If they don't pan out, it's not the end of the world, because if you let it go for say 5 or 10 years or something, you might still have 30 years to make up for it. All right, so be a little bit more risky when you're younger, and then once you start getting a little bit older, you need to start being a bit more conservative with the types of shares you invest in, and maybe have a higher proportion of cash. But people that have got all their money in cash at the moment, not making anything, because the interest that you're getting on cash is negligible. So you're better off maybe when you're young anyway, trying to do a few little things, because it adds up. It's surprising how quickly that money adds up. Well, it doesn't take long at all. So, and that's for you when you're old, and it might be the difference between whether you have one holiday or 5 holidays, or the difference between whether you stay in 3-star or 5-star when you're old. And I promise you, when you're old like me, 5-star is, you know, it's a lot better, and it makes a big, big difference, especially if you go to somewhere like Thailand and you want to make sure that you've got working air conditioning because it's hot, or even Singapore because it's hot. Having said that, though, even those 3-star hotels are quite pretty good in Singapore. So anyway, why is it important, like I've said to you before, to divide between current and non-current? It's because of risk. Now, Centro got into a lot of trouble. They had over $3 billion that they misclassified as non-current when it should have been current. And if you're an investor and you see someone's got $3 billion worth of current debt, you'll be going, hang on a minute, what's going on here? Well, they, they basically fraudulently misled everybody. Directors went to jail, got fined, not allowed to act as directors anymore, so that was a few years ago. Also with Dick Smith. So some of you might remember Dick Smith, some of you might not, an electrical retail company. So Dick Smith has been associated with quite a lot of things. It's just unfortunate that his name really, when he sold it off, that's one thing you've got to be very careful of. If you feel entrepreneurial, best not to use your own name, because even though everything might be fine now, 10 years down the track it might not be. And if your name gets associated with something which you might not have a lot of control over, which Dick Smith didn't because he'd already sold off the business, but what happened is the people that took over the company and then packaged it and then sold it off and everything, they told a lot of lies, basically completely overvalued old inventory. Because remember, Dick Smith, it was a tech company, right? So a lot of computers, a lot of technological equipment, stuff like that. And it goes out of date fairly quickly, right? And if you're not turning it over, I quite like Dick Smith actually, and I've bought quite a few computers from Dick Smith, but no more. So if you are feeling entrepreneurial, just be careful whether you put your own name to it. Okay, let's have a look at the profit and loss. So there are 2 components to your profit and loss: your revenue minus your expenses, and then your other comprehensive income. Right, so your revenue is your normal income, your normal operating income. Your other comprehensive income is stuff which is outside the norm, right, which could be revaluation of your assets. It could be things to do with foreign exchange gains and losses, stuff like that, right? Could be the thing that you also have to do is you must separately disclose the tax related to the other comprehensive income separately. All right. So is it different to how they used to have it in the past, where you had normal items and extraordinary items? So in the past we used to be able to separately disclose things that were outside the norm under extraordinary. Now we have other comprehensive income, but it's not the same as extraordinary. All right, so we can have a single statement with 2 sections or 2 separate statements. All right. For the purposes of this unit, we generally focus on the main. We don't have too many other comprehensive income, even though in this example there's a couple. We do a couple of little bits, like I said, with a foreign exchange gain or loss and the sale of property, plant and equipment, but we don't do an awful lot with that. All right, so let me move forward. So we must, like I said, you must separately disclose the tax relating to other comprehensive income. Okay, let's do the minimum line items. So when you're doing a profit and loss, there are minimum line items. You must show your revenue. If you've got different components of revenue, if you've got separate, distinct areas of business, you must show them separately on the face. if they are material. So not material, then you'd have a note and you show it in the note. Finance costs, you must show finance costs separately, right? That's your interest. Why do you need to show it separately? Because you've got lots of ratios where you include and exclude interest, because interest is risk, and looking at a company's ability, banks are a pretty good indicator of risk because they're not going to lend you money if they think that you're risky, right? People want to know what your interest rates you're paying and stuff as well, and they might not be able to see that from just the numbers, but you can work it out pretty easily, right? And you can see whether someone's getting a better interest rate than you, because remember, that's part of competitive advantage when you're in business. If you're able to negotiate better interest rates, even on your home loan, if your home loan now, if you haven't negotiated a 3 point something as part of your home loan, you're paying too much. You should be able to negotiate down to around about 3.8, 3.9. If you haven't got that already, you need to go into your bank and put your foot down and say you're going to move somewhere else, because over the life of the loan, that adds up. It adds up to a lot. And, people get complacent because you've been with the same bank for 20 years. I know I am. But I go every time there's changes in interest rates. If I see someone getting a better rate than me, I'm into the bank asking for the same competitive rates. So you should do the same, because it's thousands and thousands of dollars, right? So when you're looking at the median house price in Perth, it's still like 500,000, right? So not everyone's paying that. So there's different areas, but everyone's paying at least, 200, 250. Right, that adds up. Okay, so you must show your finance costs separately. If you've got share of profits relating to joint ventures, which we're not going to do in this unit, but that needs to be shown separately. Your taxes, right? So you must show a before tax figure and an after tax figure. And from your tax unit, you'll understand that when you calculate tax, it's not, let's say it's 30%. So for small businesses, it's gone down now to 27.5, but let's just assume it's 30%. The tax is not always going to be 30% of that profit figure, is it? Because you've got deferred tax assets and liabilities. Some things are non-taxable as well, right? So it doesn't always work out like that. So you must show your before tax and after tax. You must show each component of other comprehensive income classified by nature. Right, so things that are separate and distinct must be shown separately. You can't just show it in there as one line. If there's any non-controlling interests as well, you have to show them. Okay, so you know what your income and your revenue and gains are. So you've got your normal revenue and then other gains. So we did a little thing about statement of profit and loss. When you are disclosing by nature on the face, in particular it relates mostly to your expenditure side. You can disclose by nature or function. So the nature, it is a separate and distinct activity. So it is advertising, it is salaries, it's depreciation, right? Or alternatively by function, where you group it together, where you might have selling costs, admin costs, production costs, right? And within that you might have multiple components within that, all right? So the problem with doing it by function is it's arbitrary, because let's say you've got an admin assistant. They are 20% in the admin area, 20% in the marketing area, and 60% in the production area. So you would arbitrarily take that percentage of their salary and put it to production costs, for example, right? So, but that's arbitrary, because that's what she's supposed to do, but that may not be what she actually does, unless she does time sheets and they can actually determine exactly what they're doing, which any of you who go and do work for an accounting firm, they usually charge probably like within 15-minute intervals. So you're actually charging for every 15 minutes, and it's maybe going to different things, different cost centres and things like that. So what proportion relates to what areas. So it is potentially possible to be a lot more accurate with your allocations, right? But they're still subjective. Okay, so there's a little example of a consolidated statement for, this one's for Qantas. So you can see we've got revenue, and they've divided it separately. They've got one core area of passenger revenue and one of freight. Right, so that's their core business. The expenditure, they've got manpower and staff-related costs, so salaries, remuneration, right, maybe annual leave, things like that, long service leave costs, all popped into one. But they haven't got a separate note there, so maybe they don't think it's important enough to separately show what relates to salaries and other leave entitlements and things like that. So fuel, so you get the drill, but notice how they separately disclose finance costs, right? And then they have a before tax and an after tax, so they separately disclose the income tax expense. So remember, that's the minimum requirement. You must show your revenue. You must show your core expenditure divided by nature or function, right? You must show your finance costs separate, and you must show your income tax separate, right? So, but the individual items that you have in between, that obviously they can vary. So notice how they've also got earnings per share down the bottom, right? So that's also a requirement to put in their earnings per share. Okay, so they've got a consolidated separate statement to do with comprehensive income, and if you look at some of those items, they've got some adjustments to do with fair value and hedging and foreign currency, right? So those are things that are a little bit outside your normal operations. Okay, so figure 5.8, so I'm just going to turn this air conditioner back on because it's too hot. So there's an example there in your book, your statement of profit and loss. So we'll do another couple in a second. So your statement of changes in equity. So your equity is your wealth. All right, so your equity is your wealth. It's your original contribution plus the money that you're making. So that's essentially what your whole balance sheet is. It's your wealth, right? And the statement of equity shows the movement in your wealth. Right, so hopefully you're making profits and not losses, but remember, things can be contrived. Right, so sometimes it's in the advantage of some businesses to maybe have losses, right, because for taxation purposes and things like that. Gosh, you want to hear some of the weird things that you hear about them doing in America with art fraud and stuff like that, where they sell artworks and then they get revalued. You sell them for like $5 million, and then all of a sudden somebody finds out that these are unique pieces, and then all of a sudden they're like $100 million. But if you've donated it, so you bought it for $5 million, then you donate it and you get a tax deduction for donations and stuff like that, and for art antiquities and cultural stuff. Then all of a sudden, you bought it for $5, but it's $100 million. You get the $100 million tax deduction. Right, so there's the things that you hear about that the super rich do to avoid paying taxes. Anyway, let's have a quick look. So let's go through that. So statement of changes in equity. All right, we will look at an example of that shortly in one of the handouts that we do. So we'll look at one that's a little bit simple. This figure 5.11, you've got a reference point in your textbook, so let us have a look. Don't forget the notes. There is one additional note that you must do, and it's usually the first one I always look at. If I'm analysing a company, the first note that I look at is the auditor's remuneration. So you have a look at what are they getting paid to do the audit, number one, and are they getting any other consulting fees? Right, so where an auditor seems to be getting quite high consulting fees, you start to go, hang on a minute, are they still independent? Right, so they might get paid $1 million to do the audit, but they might get paid $5 million to do consulting fees. Then you sort of think, well, what's really going on here? Now, that used to be very common. It's not as commonplace now. The way that the big auditing firms get around it as well, because remember, there is a requirement that you have to change over your auditor much more frequently than you did in the past. It's a new requirement. So fairly recent, in the last 4 or 5 years. But what the big auditing companies do is they set up within their own, like let's pretend it's Pricewaterhouse or Ernst Young. So within their company, they set up teams of people. And they say that these teams are separate and distinct and independent. So that you have one team that goes in and they're auditors for 3 or 4 years, all right? And then they try to retain that because they've got that knowledge, but then they'll say, we'll take them out, we'll put a new team in. And that's how they try to get around the rules and the law that says you need to change over more frequently. Sometimes it's acceptable, but other times maybe not so much. It's actually better for the company if they do change over. Having said that, the first year of a new auditor coming in, right, it can be very, very expensive. Right, so it can be a cost-effective option for a middle-sized company to do that. So if they've still got a good auditor, so they've still got Ernst & Young, for example, or Pricewaterhouse or Deloitte, where they can actually show that there's a distinction and that team has had nothing to do with that company at all, it's like a whole new group coming in, then they can get it signed off. Right, the ASIC and Australian Securities Commission can sign off on it. It's always better though for perception if you get a new one completely. Okay, I'm not going to dwell on the notes. I want to actually get to the examples that you've got in front of you because we've only got a little while left. We've only got 20 minutes left, so we'll just go through that. So question 5.1, you've got that in front of you in the handout. So if you came in late with a handout, there should be one on the back there. Is there any left up there? Yeah. Okay, so let's actually do 5.1, 5.2 and 5.13. So we'll go through them fairly quickly and then we're done. So anyway, you've got the feel, you know what your statements are and you know what you have to present. You know you've got a very good reference point with AASB 101, right? What I would do is I would start to familiarise yourself with that standard anyway. Start looking at it. Look at the definition, the recognition and the disclosure requirements in that standard, because if you're going to be a financial accountant, you have to know that standard, so you might as well start getting used to it now. All right, and it's going to benefit you anyway with the assignment. All right, so having a good, clear understanding about how you should present things. So 5.1. If we look at what's required, it says prepare a statement of profit and loss and other comprehensive income for Frontier Limited for the year ended 30th of June. We're going to classify the expenses by function. It's the only thing we can do anyway because that's the data that we've got. So by function means we've got admin expenses as opposed to, separate salaries for admin staff and, other related expenses. So we've got selling expenses, admin and other. So notice how our finance costs are our interest expense is shown separately in the data. That allows us to present it separately. All right, we know we have to show our revenue and our cost of sales, so let's go through and prepare it. But before we do that, the profit before tax at the end of 30th of June was $388,000, and we also know we've got land has been revalued and there's a gain of $20,000. So we have to assume that the tax rate is 30%, so we need to include that as well. So if we have a look here, so if you want to write along, you can, but you'll know that it's in the handout for you. So you might already have it there in the slide. So you've got your revenue minus your cost of sales to give you a gross profit. Remember, if you're not making gross profit, your markup's not high enough. Gross profit relates specifically to selling items, all right? And that really just shows you your margin if you're not charging. So, because remember, if you're not making a gross profit, you can't pay for anything else. You can't pay your electricity, you can't pay your wages. On average, for most businesses, not all, salaries is your biggest expense, usually about 80%. Okay, so we've got selling expenses, admin expenses, other expenses, but we need to separate out our finance costs. So our profit before income tax, $388,000. So it reconciles to what the question told us. We have got income tax expense there, of 116,400, just assuming that it's 30 cents in the dollar. Remember, in the real world, that's not that simple. All right. Profit for the year, 271,600. We have other comprehensive income. We've got a gain on revaluation of land, 20,000, minus out the tax component of that of 6,000, and giving us other comprehensive income of 14,000, leaving us with total comprehensive income for the year of 285,600. All right, nice and easy just to get into the swing of doing a standard profit and loss. Revenue minus expenses gives you a profit figure. So from a presentation point of view, we must separate out our finance costs and our tax. Right, and we must show our other comprehensive income separately. So we've got our land and buildings, our land revaluation and the tax. Separately disclose the tax on the other comprehensive income. So it's easy, right? So that gets you into the swing of it. The next bit is just a reminder for your classification. So if you have a look at 5.2 over the page on page 2, right, the question asks us to basically, it says requires, number one, we've got a name, the name of the line item where it would appear on the statement of financial position, and then our classifications to whether it is current or non-current. Again, just getting you into the swing of the terminology and the language. So if there's things that you haven't heard of before, if you can't quickly Google them, if you've not heard of the language before, quickly Google them and see what it is as you're going through. Remember, you can't do that in the exam, right? So what you need to do is try to become familiar with the business language as you're working through. So we've got goodwill. So you know what goodwill is. We did some exercises on goodwill last week with our business combination. So it's an intangible asset. Remember, goodwill can only be purchased, right? And your goodwill is a non-current asset. Your share capital is an equity item. Your cash at bank is part of your cash and cash equivalents under your current assets. Dividend payable. So there's usually only two sorts of dividends. You've got an interim dividend and a final dividend. They are usually payable within 12 months, so it's a current liability. Accounts receivable, right, current asset and part of your trade and other receivables. Machinery is part of your property, plant and equipment. It's non-current. Debenture, so you know what a debenture is. We're going to look at another debenture question in the workshop today. It's a non-current liability, but there could be two parts to that. Remember, because there could be a current part which is payable within 1 year, and then another part which is payable 9 years from now. All right, so potentially those debentures could be divided into current and non-current. Having said that, debentures normally have a fixed date, and that fixed date is in 10 years' time, but it depends on the nature of it. But you could have multiple sorts of debentures. Some might be current, some could be non-current. Provision for your long service leave, right? That's part of your employee benefits. It's a non-current liability. But again, you could have a current portion and a non-current portion, stuff which people are eligible to have now. So long service leave as an entitlement when you've worked for a company for a long period of time. They will say, if you work for us for 10 years, we'll give you 3 months off paid, right? So, but you have to work for that time. So if you've worked that time and you've accumulated that leave, it is current, right? Other people might still have to work the 10 years. So those that are entitled to it in the current year, you need to divide it into the current and non-current portion. Accounts payable, pretty obvious, it's your trade and other payables, current liability, your asset revaluation surplus. So when you're making profits in your business, sorry, not that one. So your asset revaluation surplus is where your assets are being revalued and they're going up. All right, depending on what they are. You've got, you might have other types of asset reserves and that as well, where you might set aside money for replacement. Asset replacement reserves, they're part of your equity. Okay, so there's just a few examples. So let's have a look at 5.13 and then we're done. So 5.13, when you go to the bottom of the question. It says prepare the statement of financial position and the statement of changes in equity as at the 30th of June 2021. All right, so we've got to do our balance sheet first, but let's have a look at what the data that we've got. All right, Mercury has suffered losses consistently, and after the preparation of their P&L and comprehensive income, the following ledger balances were as follows. So there's share capital, accounts payable. So the way that you would approach a question like this is go down the list and decide whether it's a current asset, current liability, non-current asset, non-current liability, or equity. All right, when you're going down the list, you classify it, put it under the right heading, and then we work it out. Looking at the additional information, we've got a loan. It matures on the 31st of December 2021. There's an additional note that we're going to have to do for the auditing firm. There were some additional ordinary shares that are issued and a balance of retained earnings of 139,000 and a loss for the year was 46. So we know what the loss is. So when we do our statement of changes in equity, we've got an opening balance there for retained earnings, and we've got a loss figure there of 46, so we can work out what our figures should be. So, all right, if we go to work out our current assets, we've got trade and other receivables, and we've got inventory. Your trade and other receivables is made up of your accounts receivable minus out your allowance for doubtful debts or allowance for impairment of receivables. All right, so it's allowance for doubtful debts or allowance for impairment of receivables. So remember, there's multiple terminologies that mean the same thing, so you need to get used to that. Right, and your inventory, so we haven't got a breakup, but if we did have a breakup, we'd need to have a note to show what the differences are between our work in progress, raw materials and finished goods. All right, but we know that it's 347,500. Total it up, total current assets 587,500. Got our non-current assets, property, plant and equipment, and we've got goodwill. We need to have a separate note for your property, plant and equipment. All right, so we've got our opening balance minus your accumulated depreciation to give you a closing balance. So the other thing that this question doesn't do, which is required by AASB 101, remember, current year and previous year if you've got it. Right, we don't have it, don't need to worry about it. All right, just reminding you as we're going along. Liabilities, looking at our current liabilities first, we've got trade and other payables, only one item in there. You might have other payables or other short-term debts. So you've got short-term borrowings of 175 made up of your bank overdraft and your loan of 125 to give you the 175, and you've got a current tax payable of 6,000. So what you should be doing as we're going through, I'm going through it quickly, but you should be ticking them off as we're going through. So we tick them off. All right, so making sure you don't miss anything, get yourself into a rhythm when you're preparing your statements. So we know that we've only really got enough info for your balance sheet. We didn't, because remember, normally you'd prepare your profit and loss, then your balance sheet, then your statement of equity, then your cash flow. Okay, next part, your non-current liabilities. We've got long-term borrowings there. We've got a long-term bank loan of 100,000. Total up your non-current liabilities of 100,000. Add back your non-current your total there for your current liabilities of 426. 426 add 100 gives you 526. All right, so remember that your net assets, total assets minus total liabilities, should equal your equity. So we are looking to reconcile to 439,000. So our share capital, so checking as you're going along, you've got share capital there of 625. You have got retained earnings there of 186 minus them out because it's a loss. So if you have a look at your it says, where do we get that? It's those two added together, so the 139 and the 46 is the 186. Okay, and then the extra note that we need to do there is your audit fees, so the different fees that are payable for tax advice and consulting advice. All right, so that's what your balance sheet looks like at the end, all nice and neat. All the headings are your main titles required by AASB 101, your minimum requirements. However, remember, there is some flexibility, right? There is flexibility. You don't have to necessarily use just that. You can put more on there if you want to, but remember, if you're a bigger organisation, you don't really want everything on the face. You want it all to be nice and neat and then have detail in the notes. Okay, so your balance sheet balances at 439,000. You do your statement of changes and equity. Notice it must equal your 439,000. So if your balance at end of your share capital is 625 and you issued some ordinary shares during the year of 125 because we're told so in the note, note C, means your opening balance must have been 500. So we've worked backwards to get that. All right, you won't find it there straight away, but you have got the ending balance and you do know that you issued shares. Your retained earnings, we are told in the question that your opening balance is 139. We are told that the loss is 46 to give us 186. Total it all up, it balances to that 439. All right, nice and easy, 2 columns. Gets a little bit more complicated later when you have a few more items in there. All right, in your statement of equity, just go back and have a look at what Qantas had in theirs. They had multiple items sitting in there, so we'll do more examples now. So go back and have another look at that and look at the requirements. So that's just all the notes together, so that'll be up there on Blackboard for you. Now just a reminder for the exam. Okay, so it's 4:15 now, so we've got a few minutes. So remember, you've got the information summary up on Blackboard, so you know what's in the exam. So everything up to this week, but there is no tutorial next week, right? So next week's a teaching-free week, right? I haven't specifically organised any face-to-face consultation or anything, so unless I get lots of requests, then I will make some time. Otherwise, email to your heart's content. Now, you know that there's a number of sections, so you'll get questions on the shares and debentures. You know you're going to get a question on business combinations, and that they are calculations. All right. In the workshop today, we will do business combination questions, and we will do another share question as well. So we've got 2 new questions. So those of you who've got time between now and class, if you haven't done your homework, you've got an hour and a half. Go and do your homework, because the 2 questions, you've got the answers up already. If you've done them, all right, if you don't understand them, it's all right. We'll still go through them in the class, but I want to go through them fairly quickly, so we do 2 new questions so that you get extra practice and you get more prepared. All right, so you've got some answers for your online for the business combinations. All right, so we're going to do 1 new business combination and 1 new question on shares and debentures, all right, in the workshop today. So you know what you're in for. So next week, teaching free, then in the lecture. So 3 o'clock, make sure you're here. 3 o'clock on the dot, or 15 minutes before. I'm going to try and get into the room as quickly as possible. There is a class before us, but the quicker we get in, the more time you have, all right? Because we'll just have the time in the lecture. Yep. Yeah, just your normal. So it's not open book, it's a closed book. So yeah, any calculator is acceptable, but just make sure you've got the memory cleared. So it will be in here. So we've got plenty of room, so we'll have a full house. So we should have about 40 or so in here. So get in here so early to get your spot. All right, but I'll have to, hopefully the lady before us, maybe she'll leave a little bit earlier, and then we can get in and get started on the dot and get going, and you can have the full amount of time. But remember, we're supposed to be out of the room 10 minutes before the end, so I've only allocated to that. But if people are struggling, I'm happy to go to the end. it's a couple of minutes, it really doesn't make that much difference to me, to be honest. So it's a mid-semester as well. It's not like the final exam. Final exam is boom, 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 and other people are the invigilators. So, but it will only go to the end, only to 4:30, but technically we're supposed to be out 5 to 10 minutes before. All right, so yes, so that's it. So I hope everyone has a nice break, and then when we come back, we'll have a little bit more of a look at the corporate disclosure. But what I meant to mention, the questions for the corporate disclosure is in the exam. There's not really what I would call it's not like the other two questions. The other two questions is quite a lot of calculations, right? This one, there might be like a really basic calculation, but I mean, it's really, really basic. So so it's not like a case study, right? There are individual multiple choice questions for corporate disclosure, more theory based, and broad. You don't have to say according to AASB 101 section X, and it's not like that. I don't expect you. It's not fair to expect you to know that kind of stuff when you don't have an open book kind of thing. But it is broad theory, right? So you will need to read over the notes, read over the theory questions, and actually do the questions, because doing the questions helps you consolidate the theory so that you'll remember the theory better. All right. So don't not do the homework, and all the answers are already up on Blackboard. All right. But if you've got any more queries or questions about anything, I'm pretty good with email, so I'm pretty good answering. So, ask away if you need to. But the study pack is there. If there's anything on there that you think is not quite right or anything like that, let me know. But it should be fine. It's all good. All right. It's not that hard. The final exam is much harder. All right. Even though you're allowed notes, it's still much harder, because getting your head around a cash flow is always harder. All right. So these ones, there won't be anything in there that you haven't done before, but there could be something which is a little bit different. You just have to make sure that you pick up on it. All right, there is a little quirk, but you should. All right, because remember, it's multiple choice. The answer is in front of you. So if you didn't pick up on it, when you start looking through the answers, you'll go, that's what I didn't do. All right, so you have the advantage when you're doing a multiple choice that if you've done something not quite right, you should pick up on it. All right, okay. I'll see you all at 6, those of you that are coming to the workshop. Thanks for coming.